In the dynamic world of business, companies constantly face evolving challenges and opportunities. Financial restructuring stands as a powerful tool for businesses to adapt, improve, and thrive. This process involves making significant changes to a company's financial structure, operations, or both. By strategically adjusting elements like debt levels, ownership, and asset allocation, companies can overcome obstacles and position themselves for future success. Financial restructuring is not a one-size-fits-all solution. It encompasses a wide range of strategies, each tailored to address specific circumstances. Whether a company aims to reduce debt, streamline operations, or unlock hidden value, understanding the nuances of financial restructuring is crucial. This essay delves into the core concepts of financial restructuring, exploring its various forms, benefits, and potential drawbacks. We will examine strategies such as leveraged recapitalizations, debt equity swaps, and leveraged buyouts. Additionally, we will analyze the impact of dividend policy changes and explore business reorganization techniques like sell-offs, spin-offs, and management buyouts. By understanding these concepts, businesses can navigate the complexities of financial restructuring and emerge stronger, more resilient, and better equipped to face the challenges and opportunities that lie ahead. Companies pursue financial restructuring to address challenges or seize new opportunities. One primary driver is financial distress. When a company struggles to maintain financial health, restructuring becomes critical. Significant financial challenges, like declining profitability, can be daunting. Excessive debt or inability to meet obligations puts immense pressure on a company. Restructuring can provide a lifeline. By restructuring, a company can reduce costs, improve cash flow, and regain financial footing. Restructuring isn't just for distress. Companies also restructure to capitalize on strategic opportunities. This proactive approach can position a company for future success. For example, restructuring can facilitate growth by reallocating resources to promising areas. It can free up resources for new products, markets, or technologies, enabling expansion and increased market share. Streamlining operations and improving efficiency can lead to a leaner, more agile organization. Restructuring can unlock hidden value by separating underperforming assets and improving governance. Financial restructuring is a versatile tool for addressing challenges and opportunities, positioning companies for long-term success. By selecting appropriate strategies, a company can leverage restructuring to achieve strategic objectives and thrive in a competitive environment. A leveraged recapitalization is a financial restructuring strategy in which a company takes on a significant amount of new debt to finance a special dividend to its shareholders or to repurchase its own shares. This strategy can be a powerful tool for companies looking to defend against hostile takeovers, boost their stock price, or increase shareholder value. In a leveraged recapitalization, the company's debt-to-equity ratio increases significantly, which can make it less attractive to potential acquirers. The increased debt load can also act as a deterrent to activist investors who may be seeking to gain control of the company. While leveraged recapitalizations can be effective, they are not without risks. The increased debt burden can put a strain on the company's cash flow and make it more vulnerable to economic downturns. Additionally, if the company's earnings do not increase sufficiently to offset the higher interest expense, its financial condition could deteriorate. Despite the risks, leveraged recapitalizations can be a valuable tool for companies looking to enhance shareholder value and defend against unwanted suitors. However, it is essential to carefully consider the potential risks and benefits before implementing such a strategy. Debt equity swaps represent another crucial tool in the realm of financial restructuring. This strategy involves exchanging existing debt for equity, or vice versa, to optimize a company's capital structure and improve its financial health. There are two primary types of debt equity swaps: equity for debt swaps. In this scenario, creditors agree to exchange a portion of the company's outstanding debt for newly issued equity shares. This reduces the company's debt burden and improves its debt-to-equity ratio, making it more financially stable and attractive to investors. Debt for equity swaps. Conversely, this type of swap involves a company issuing new debt to repurchase its existing shares from the market. This can be advantageous for companies with undervalued stock, as it allows them to retire shares at a discount. However, it also increases the company's debt level. Debt equity swaps offer a flexible approach to restructuring, allowing companies to tailor solutions to their specific needs and market conditions. By carefully assessing their financial position and goals, companies can utilize debt equity swaps to achieve a more balanced and sustainable capital structure. Leveraged buyouts, or LBOs, represent a complex form of financial restructuring. This maneuver is not just about acquiring a company, it's about transforming its financial landscape. In an LBO, a company is acquired using a significant amount of borrowed funds from sources like banks and private investors. The acquired company's assets are typically used as collateral for the loans, leveraging its own resources to finance the purchase. This strategy takes a company private, meaning its shares are no longer publicly traded, allowing for more flexible restructuring strategies. LBOs are often initiated by private equity firms or company management teams who see potential in the company. They work together to identify areas for improvement and value creation. The primary goal is to unlock value by improving operations, selling underperforming assets, or restructuring financial obligations. Being private allows the company to make bold moves without public shareholder scrutiny. While LBOs can generate substantial returns, they also carry inherent risks, including significant financial strain. High debt levels can burden the acquired company, making it vulnerable to market fluctuations and operational challenges. This can lead to financial distress, layoffs, asset sales, or even bankruptcy. Additionally, the focus on debt repayment can hinder long-term growth initiatives, stifling innovation and expansion. Despite the risks, LBOs remain popular, especially in industries ripe for consolidation or operational improvement. Companies considering an LBO must carefully weigh the potential rewards against the risks, ensuring thorough analysis and strategic planning. Dividend policy, which governs how a company distributes profits to its shareholders, plays a crucial role in financial restructuring and overall corporate finance. Changes in dividend policy can significantly impact a company's value, growth prospects, and risk profile. A well-thought-out dividend policy can attract investors looking for steady income, while also providing signals about the company's financial health and future prospects. Companies have several options when it comes to dividend policy. Stable dividend policy. This approach involves paying a consistent dividend over time, even if earnings fluctuate, providing predictability to investors. This predictability can be particularly appealing to risk-averse investors who value the assurance of regular income. Constant dividend payout ratio. Here, a fixed percentage of earnings is distributed as dividends, aligning dividend payments with the company's profitability. This method ensures that dividends are directly tied to the company's performance, making it a transparent way to share profits with shareholders. Special dividends. These are one-time dividend payments made in addition to regular dividends, often used to distribute excess cash or reward shareholders after a successful period. Special dividends can be a way to share unexpected profits or to return surplus cash that the company does not need for immediate reinvestment. Stock repurchases. Instead of paying cash dividends, companies can repurchase their own shares, which can boost earnings per share and signal that management believes the stock is undervalued. Share repurchases can also provide tax advantages to shareholders, as they may prefer capital gains over dividend income for tax reasons. Changes in dividend policy can signal a company's financial health, future prospects, and risk appetite to investors. For example, an increase in dividends might indicate confidence in future earnings, while a dividend cut might signal financial distress. Investors closely watch these signals to make informed decisions about their investments. Understanding the implications of dividend policy decisions is crucial for companies undergoing financial restructuring. By carefully considering the trade-offs between returning cash to shareholders and reinvesting in the business, companies can optimize their dividend policy to align with their overall financial strategy. This balance is essential for sustainable growth, as it ensures that the company can continue to invest in new opportunities while also rewarding its shareholders. Ultimately, a well-crafted dividend policy can enhance shareholder value, support long-term growth, and manage risk effectively.